It is Friday the 6th of September. I'm your host Ryan Kia and this is the Quantium Cast. Today's episode is going to be relatively short as I have to make the train at 7:32, and by uploading everything I just can only assume that I'll be able to make 2 or so today. So today's focus stocks won't be consisting of more than maybe 1 or 2. We'll have to see how the headlines are, because at the moment it's 6:44 and I am tired, one eye open, but I can imagine many of you are too, ready for the markets, one eye open for the markets, one eye closed for all the crap with the B word. But anyways, I think it's about time we get into today's focus stocks. We have 2 companies, the first of which is Berkeley Group Holdings, and the second one is Greene King. I mean, I'm not going to make any references with Berkeley Group Holdings, but this company actually, if you look at their chart over the past 20 odd years, almost looks like Berkshire Hathaway. It's quite funny, because the shares rallied from 1998 at around 90 pence per share, all the way to the current price now of £38.73, signalling something like a 4,000+% rise. But anyways, Berkeley Group Holdings, as we come to talk about it, is a construction firm, to put it simply, and they have mentioned that their forward sales position remains above 1.8 billion. We should constantly compare everything to their market cap. Their market cap's 4.8 billion. Is this, I believe, in the first half? I think so, I believe. May to August. So you've got, 4 months odd. It's almost half. It's quite weird. They mentioned in the first 4 months of the new financial year, the first third basically, market conditions have been robust and pricing has remained stable. So that's decent. If we times that by 3 just for the sake of measurement, they're basically at a price to sales ratio of say 0.8 or so. But price to sales is never important. It's about the margin. Price to earnings is probably a better measure to use, rather than things like EBITDA or even sales, which is just a unique thing in itself. Many people don't even use price to sales. It's like using book to asset value to try and see what a company is worth. But in reality, if a company is losing money, even if their book to asset value is attractive, they are just depreciating their entire net asset value. So why are you wasting your time? They also mentioned that they have an extension of their £280 million annual shareholder returns program. So this company has a decent idea going forward to help their shareholders by giving dividends back, something like £2.22 per share. So that gives them a dividend yield of something like 6-7 odd percent, which is decent to say the least. And they look to give a pre-tax return on equity of around 15% year on year, which is very impressive. If we look at the shares over the past year, they've been very volatile, range bound from around £32 lows to just under £40 highs. But if we look at the year's return on equity, it's around 8%. If we look at the previous year, we can see they did much better. They got around that 13-14% level, near to the 15% they aimed to achieve. And they've mentioned that they want to pay £134 million back to their shareholders by 31st March 2020, and that will be paid as a dividend. That's something like £1.11 a share, so a 3% yield just alone is to come. It's very decent. And they've even mentioned that is before taking account of any share buybacks in the intervening period. One worry is, though, when companies continue to just buy back shares, they are effectively borrowing money at times, because what happens with your net debt is when your cash figure reduces, your net debt figure increases, assuming that you have liabilities, which almost every company you come across does. So borrowing to basically, well, they're not borrowing, but it comes up as borrowings on the accounts. To buy back shares is effectively stupid, and it creates a corporate debt bubble, which a lot of people are trying to not talk about because they hold corporate bonds in their ISAs and everything. But I think we should be very careful. The company is worth £5 billion. Berkeley Holdings Group plc stands at a market cap of 4.87 billion, just to be exact, and their P ratio is around 8, so they're relatively fairly valued. I can only assume that they have mentioned something about Brexit, and they said that there could be risks of them delivering certain materials and components. But anyways, they've mentioned that the business has a long-term profit goal and they have a long-term nature, so they aren't going to be hit by these short-term fluctuations. At least that's what they're saying. They want to do something like £3.3 billion in pre-tax profit over the next 6 years to April 2025, the 30th of April. In fact, I can only assume that this is an optimistic goal because the company's paying quite a lot out to shareholders. But nevertheless, it will be interesting to see how things turn out after this report has been released to the market, and the market's open at 8 o'clock in 51 minutes time. Moving on to Greene King Group, this company with the ticker symbol GNK has been founded ever since 1799, and they have over 2,700 pubs, and you've probably guessed it, Greene King is one of the country's leading pub retailers and brewers, and they have released a trading statement for the 18 weeks to the 1st of September 2019. Swiftly moving on to Greene King, this company had been bought out, in fact, at £2.7 billion by Hong Kong's richest man. That news was released, I think, something like 18 days ago, so just over 2 weeks. And that sent the company's shares all the way from £5.63 a share to £8.40 per share. So that gives them a market cap of just over 2.6 billion, and their P ratio there will be around 21. But what we should look at now is the first quarter trading update, and we'll only be able to see net income down about 4%. In fact, 4.2% for the first 16 weeks, driven by softer like-for-like beer sales they've mentioned. And in brewing bans, beer volumes were down quite a bit. In fact, 6+%, which isn't the greatest thing to see. They've also mentioned costs have inflated by around 10 to 20 million pounds. What we have also seen in this RNS is that the company is still disposing some of their pubs. I believe that their program for this year was to dispose around 85 to 95 pubs this year, generating disposal proceeds of around 45 to 55 million pounds, which funds the opening of 8 new pubs. Quite an ugly thing, eh? To dispose of all your old ones and try and get a tenth of that in new pubs. I wonder that to me is a little bit worrying with regards to company management, because the company, I can only assume, Greene King, is having huge problems, or had been having huge problems with those 85 to 95 pubs, to give them all up to just open 8 new pubs. The final bit that we should probably cover is the fact that Greene King announced that they will be sending out a final dividend to their shareholders of 24.4 pence per share, which is quite decent. That's about 3% on the current share price. If we look at the chart over the past 5 years, they've had highs of around £10 per share, lows of around £4.60 per share, and they were range bound for the past year at around £4.75 to highs of £7.04, and went all the way down to something like £5.90, and then got the takeover offer. So I can only assume that the guys who wanted to take over Greene King, CK Noble, the holdings company on behalf of one of Hong Kong's richest individuals, had been acquiring shares, because they've offered something like 850 pence per share. The shares are about a penny, in fact about 10 pence beneath that price. I can't assume this to be a trading share because once there is a takeover offer, it's almost as if you have a ceiling but also a floor. A situation where if the price goes above, people aren't really going to pay more because they know that this takeover price is remaining and it is a fair valuation. In fact, a valuation with an added premium, because once again it is Hong Kong's richest man acquiring, or one of their richest people. But if the price were to break below, individuals would be confused because the takeover price was at 850 pence per share and the price already now is at a small discount. It's basically trading at that price if you don't really care about 1%. But what I like to see is that the company hasn't mentioned anything about Brexit. They have mentioned that their revenues were down because last year's successful World Cup had a lot of people going to their pubs. I can only assume they had a good marketing campaign that boosted their revenues, but still we haven't seen growth. So I wouldn't assume the share price to react positively on the back of this. But once again, when you've got a rich man involved, or a rich woman, we don't discriminate, you can likely see them just buying back shares or buying more shares or whatever, because now this takeover has occurred. The majority of the share capital is owned by this individual or his holdings group, and it's very likely that the share cannot be manipulated on the downside and things of that nature. But anyways, I've been your host Ryan Kia. I've got to head off really quickly, got to train, and got a long day of lessons to attend. I hope all of you have a wonderful trading day, and even if you're feeling negative, turn some of that bad energy into good vibes and positivity, and I'll see you all in the next episode, likely over the weekend, if not Monday. I've been your host Ryan Kia. Until next time.